It's interesting that it's almost a definitional outcome. If you produce a lot less and you supply a lot more money
Yeah.
for a given amount of services and goods, at some point in the future, inflation could rear its ugly head. But I guess from your answer, it's such a complex evolving piece that my only conclusion is that you must be heavily diversified across a couple of these potential outcomes.
I think that's right. And, the way we describe that at Antipodes, I talked about stage 1, stage 2 type beneficiary, or types of investments. The other way of thinking about it is like we call it the barbell approach, because you've got this massive, very, very high P dispersion. On one hand, you have companies like a Shopify that don't have much in the way of earnings, but are trading on a massive multiple of revenue. And at the other end, you can buy, let's call it a boring telecommunications company on a 5% dividend yield, on a low multiple of earnings. So you're giving this extreme range of valuations, and it's truly extreme. Like, it's actually, you're talking about 99th, 100th percentile type environment. As a pragmatic value manager, sometimes I'm surprised we have any. It's been, because it has been such a headwind, just that dynamic for our natural style. Even if even to the extent you're trying to be relatively style neutral, the danger is that neutral becomes is quite extreme. The benchmark can become quite extreme, and therefore being neutral is also quite dangerous. So at the moment, we have a skew against some of that high multiple and part of the market, and it's a bit painful. But I think ultimately we'll get paid for taking that position. Our investors and our shareholders will get ultimately, it will be worth staying the course. But the barbell is basically that idea that not all of these low P stocks are secular losers, and it's picking through them for those companies that have businesses that are going to be relevant in 5 years' time, 10 years' time. And then at the other end, it's not closing your mind to some of the higher PE stocks. It's actually, a lot of that structural changes we want to benefit from. And we've held Microsoft from in the inception of the fund, and we still love it because we think it's undervalued as a business has evolved. We think the market has lagged the transformation that's taking place. The market's valuation of Microsoft has lagged the underlying transformation of the business as it goes to cloud, and its SaaS offering, its software as a service, its Microsoft, Office 365. They just mesh so well together. It has such a low cost distribution model for software, because that's what kills software margins. They're high gross profit businesses, but show me why doesn't Zoom or Slack or Shopify, why don't they have profits? It's the cost of selling it. Anyway, that's the barbell is, I think, what will work in this environment, and that's how when we do the opposite in the short book. We're looking for some of the irrationally expensive stuff that isn't really what people think it is, and then at the other end, we've got some low P shorts because we think they're cyclical businesses that have serious secular headwinds, which is the opposite of what we're looking for in our cyclicals. We're looking for companies that are actually secular winners that people think are cyclical, if that makes sense.